July 9th is the tariff deadline, and investors are nervous about what that means for the stock market. We've had 3 big tariff announcements in 2025, and each one flipped the stock market. The first time was February, when tariffs were announced, and that caused stocks to crash. Second was in March, when tariffs were reinstated, causing a global stock market sell-off. And the third time was in April, Liberation Day, when President Trump announced new tariffs on the world, and this caused the fastest global stock market sell-off since COVID. And now the question on every investor's mind is what's going to happen on July 9th, especially because the stock market is breaking new record highs, which makes this tariff announcement so important. Now, full disclaimer, I'm just a random guy on YouTube. Nobody knows what's actually going to happen, but I've spent hours studying the trade deals and trade concerns, and I'm going to break it all down in this video. That way you have a better idea of what might be coming. President Trump is discussing trade and tariff deals with many different countries, but the 5 largest trading partners with the United States are Mexico, Canada, China, Japan, and Germany. So for the purposes of this video, I'm going to focus in on the largest trading partners that we have. And to really understand what's going on today, we have to know what tariffs look like before President Trump entered the White House in 2025. Starting with Mexico, we had an agreement in place called USMCA. That's the United States, Canada, Mexico Agreement, which said that essentially most tariffs are going to be 0% and 0%. Meaning the United States will charge essentially no tariffs on Mexican goods, and Mexico would charge essentially 0 tariffs on United States goods, with a few exceptions, but that was the general rule. That also applied to Canada, because it was the USMCA, which meant Canada also really didn't charge many tariffs on the United States. We didn't charge many tariffs on them pre-2025, with a few exceptions. But things were a little bit different with China, because the United States had around a 3% baseline on goods coming into the United States from China, and China had around an 8% baseline tariff on goods going into China from the United States. Again, it would vary good to good, but this was kind of the average. Japan is an interesting one because we have an agreement called the USJTA with Japan, called the United States-Japan Trade Agreement, which says that we would essentially have 0 tariffs on each other, but there were some exceptions. For example, the United States put a 2.5% tariff on cars coming from Japan into the United States, and a 25% tariff on trucks coming from Japan into the United States. And in return, Japan put quotas on the United States on how much rice we could sell in Japan. And if the United States sold more rice than that, then it would be a very high tariff, more than a 100% tariff on that rice going into Japan. So I'm gonna write 0% because that was kind of the general, but there were exceptions. Germany is part of the EU, and the trade agreement with the EU is essentially that the EU, the European Union, would charge an average of 1.6% tariffs on the United States goods, and the United States had essentially the same agreement back on EU, which was around that same 1.6% tariff. Again, this is an average, but this is what the tariffs were like pre-President Trump entering the White House in 2025. Today, these tariffs are looking very different. Yes, we've been covering all of this in Market Briefs. Again, Market Briefs is my free financial newsletter for investors, where every day my team is working to break down what's happening in things like the economy, stocks, housing, crypto, and the global markets into a fun, witty, and easy to read newsletter. We have hundreds of thousands of investors that are reading Market Briefs every morning, and when you join Market Briefs, you'll also get access to my investing masterclass as a bonus, where I break down how you can get started as an investor and find hidden investment opportunities before everybody else. So if you'd like to join Market Briefs and get my investing masterclass as a bonus for free, all you have to do is click the link down in the description below. At the time of me recording this video, we do not have a solidified deal with Mexico. And to put some pressure on Mexico, President Trump has imposed a 25% tariff on assembled vehicles that are coming into the United States from Mexico, and a 50% tariff on metals like steel and aluminum that are coming into the United States from Mexico. Again, we don't know if these are going to stay. It's been kind of hinted that these tariffs are there to help negotiate a proper trade deal, but right now, those are the tariffs on Mexico, which has slowed down trade significantly. Canada's another interesting one because we don't have a trade deal with them just yet, and to put some pressure on Canada, President Trump has doubled the tariff on steel and aluminum from 25% to 50% to make them a little bit more negotiable to come up with something more favorable to the United States. Now, what's interesting about this is Canada passed a new tax, the Digital Services Tax, which would have imposed a around 3% tax on technology from the United States into Canada. President Trump did not like that. And as soon as that tax was passed in Canada, President Trump announced that he was going to be launching brand new tariffs on Canada. And when that information became public, Canada dropped those taxes on the United States. And now it looks like those trade negotiations have started again, but we don't have a conclusion just yet. China, we have some insight on. According to the Treasury Secretary, Scott Bessent, the United States and China have come to an agreement, and that agreement says that the United States will now charge a baseline around 30% tariff on goods coming into the United States from China, and China will charge around a baseline 10% tariffs on goods going into China from the United States. The negotiations are still going on with Japan, and at the time of recording this video, the United States has put on a 25% tariff on trucks coming into the United States from Japan, and Japan doesn't like it. We're in that negotiation phase right now. We'll see what ultimately happens, but we have imposed some additional tariffs on Japan, again, to put some pressure on them. We'll see what happens. And then when it comes to Germany and the European Union, we have some interesting deals going on because President Trump, again, to put some pressure on the European Union, has essentially threatened 50% tariffs on machinery and automobiles if a deal is not reached soon. And in response, the EU says, okay, we want to come up with a deal, but can we be creative? And one of the things that the EU has proposed is buying more arms, meaning weaponry, from the United States to bring some more business into the United States. Again, at the time of recording this video, the deal is not reached, but there's some interesting negotiations going on. Now, I'm gonna get into what this means for the stock market in just a minute, but let's go back and talk theory for a second, because why are we even discussing tariffs and trade deals? And I'm not gonna get into the politics of this. There's a lot of people that talk about that. Let's talk strictly finances. What is the whole purpose behind this? And it goes to a concept called trade deficits. A trade deficit is when the United States is buying more stuff from foreign countries than they're actually selling to those foreign countries, meaning we're relying more on those foreign countries than they're relying on us. You can compare that to a trade surplus, which is what the United States had a few decades ago. A trade surplus is when other countries are relying on the United States to produce products for them more than we're relying on them. And currently, we're facing a trade deficit, and it's been growing. In 2001, the United States had a trade deficit of around $378 billion, which again means we imported $378 billion more than we exported. By 2008, that number jumped up to $708 billion. But then something interesting happened. By 2020, the trade deficit actually fell to $678 billion, which meant that by here, we were actually making more stuff in the United States than selling it, versus here, we were relying on foreign countries even more. And by 2024, it is estimated that we had around a $1 trillion trade deficit, meaning we're relying more on those foreign countries than they are relying on us, meaning we're relying more on them for manufacturing and producing the products that we use in the United States. Now, this is partially a philosophical question, partially an economics question. The question is this a good thing or a bad thing? And some people will tell you that this trade deficit is a horrible thing because we're relying on those foreign countries to produce the products for us here in the United States. That makes us vulnerable. If we go to war with these countries and now we can't produce our own stuff, that's a problem. Other people will tell you we live in a globalized economy. We will want to rely on foreign countries for their cheaper labor. Why would we want to produce that here in the United States? We are so wealthy, we don't have to produce those products. Manufacturing has never come back into the United States. You can decide what's right. I just want you to understand what's going on. So one of the big drivers for these tariffs is due to this trade deficit issue that we're seeing right here, where this trade deficit in the United States has been rising. We've been relying more and more on foreign countries. And this is where now, in order to make the United States more self-reliant, instead of relying on these foreign countries, we are now passing and imposing tariffs to make it more expensive to produce products in foreign countries, to incentivize businesses to do more business in the United States, meaning manufacture and produce those products in the United States. That way we become more self-reliant instead of reliant on these foreign countries. And remember, these tariffs are a tax. It's a form of revenue for the United States government. And previous to 2025, it wasn't a huge source of revenue for the United States. In 2024, the United States government generated around $77 billion in tax revenue from tariffs specifically. In 2025, we don't know exactly how much we're going to generate, but according to Treasury Secretary Scott Bessent, we will be generating something between $300 to $600 billion in tax revenue from tariffs. This is where many investors will say, okay, tariffs can have a long-term potential benefit to the economy, but it can also have a short-term, maybe even a long-term pain to the economy. And that pain could be in the form of inflation. It could be in the form of the economy slowing. It could be in the form of jobs being hurt, although the goal is to bring more jobs into the United States. And this is where investors now have to kind of predict what they want to do in the stock market based off of what they're seeing happening here. And what many people like to focus on is the short term, which is if tariffs are higher than expected, that can make doing business more difficult because that means businesses have to pay more money to buy stuff from foreign countries. And if they have to pay more money, then they can either shrink their profits or charge you more money when you go and buy those things from the store. And both of those things can hurt business. And that's the reason why tariffs have caused so much volatility in the stock market, because investors are looking at this saying, if we see more tariffs, that's gonna hurt business and that's gonna hurt stocks. And so when you generally see more tariffs than expected, that hurts stocks, stocks go down. When you see lower tariffs than expected, investors assume that that means, okay, the economy is gonna grow faster and people can buy more stuff, which is good for stocks, which sends stocks upwards. Again, we don't know exactly what deals are going to happen. A lot of countries are scrambling to try to come up with a trade deal before the July 9th deadline. But if we don't see a lot of agreements done by July 9th, there's a chance that we could see even stronger tariffs imposed on countries to put more pressure on them, which could send stocks lower. If that happens, again, it's a big if. I don't know if that's going to happen, but what we've seen happen time and time again now, 3 times in 2025, is when these tariff announcements get made, people panic, which sends stocks lower. And each time after that, we saw the stock market rally once tariffs were kind of calmed down. I don't know if that's going to happen again, but if it does, it could create an investment opportunity for you, assuming that you are a long-term investor. Because sure, we could see a stock market crash happen after July 9th. And if that crash happens, we could see markets rally as soon as tariffs get paused. Or we could see our economy enter a slower period, which could hurt stocks for a long time. In any case, if you are a long-term investor, that downturn creates a buying opportunity. And that's where you have to know your goal. If you are an investor, we're investing for at least 10 years into the future, market downturns create buying opportunities. And that's the game you want to remember. Are you an investor? Are you a trader? If you're a trader, well, I can't help you. I don't really understand trading. That's gambling to me. But as an investor, you want to know what are the good investments that you want to buy. And when you see a good buying opportunity, take advantage of it, as long as it's a good investment. And that's why your financial education is so important, because we saw essentially 3 market crashes happen in 2025. We saw it happen in February, we saw it happen in March, we saw it happen in April. Each one of these market crashes created an amazing buying opportunity. Now, yes, we could enter a recession in 2025. We could enter a recession in 2026. We could enter a recession in 2030. Nobody knows. But if markets continue to rise in the future, which is what we've seen happen forever now, that creates a buying opportunity for those of you that are long-term investors. And again, if you want some additional resources, you can check out Market Briefs and the Investing Masterclass. I have that link for you down in the description. If you make $80,000 a year from your job, you need to make $80,000 a year from your investment income to be able to quit your job and live your life without changing anything you're doing. With your job, you have to go into work every single day to keep getting paid. With your investments, once you put your money to work, it'll keep paying.